Welcome to the Wealth Studying Podcast. This is episode 505. Today is January 4th, 2026. Happy New Year. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, everyone's doing a 2026 predictions and forecasts. Hey, I'm simply going to give you some tongue-in-cheek analysis on why I think the market can go extremely well in 2026, along with some caveats. I say tongue-in-cheek because I like to take a cynical humor approach to these things. People take themselves way too seriously. None of us can predict the future. We don't know what type of black swan events are going to happen next year. But there are some fundamentals that are currently in place, and more importantly than that, for the short term over the next 10 months, I think there are some key elements that are going to drive this stock market and potentially higher. Hey, and I know that's a challenge because if it does go up in 2026, that'll be the fourth consecutive year in a row. And I sure had a blowout year this past year. The broadly diversified and yet concentrated portfolio that was focused on industrial technology and particularly on the energy side, especially the nuclear uranium side and the fiber optic copper side, went extraordinarily well. It could actually go that well again this year, but I'm not betting on that. I am pretty much optimistic, though, that we can ultimately generate double-digit returns. And again, with some caveats. Hey, bottom line, if you're a negative Nelly, you're not going to like what I have to say today. If you're a big partisan, ideological person, one way or the other, whether you cheer for the red team or the blue team, you're probably not going to like what I have to say today. Because I'm going to take a very cynical approach, much of this based around the midterm elections. In fact, well, all of it based around the midterm elections. And the way I think about this is not from my own personal ideological preferences. When I invest, I want to be like a bookie that's taking bets. You know, if a bookie is taking bets on a football game, perhaps he has a favorite among that mix. But he doesn't let his emotions or his preference for his team to skew the fact of how he sets the odds. The odds are simply set on a very mathematical probability distribution based on the way the bets are coming in. In fact, it really has nothing to do with the teams. It's all about what the people are betting and how they interpret what's happening. That's how the odds are set. Now, the stock market isn't that clear cut, so I can't do that. But I can make observations and assess probabilities, and whether I like Tweedledum or Tweedledee, it doesn't matter. I want to do my best to go with the probability of what's going to happen, whether I like it or not, because at the end of the day, the best political stance that I've learned to take over the years is the political stance that increases my net worth. I'm digressing. Hey, bottom line, let's start with a real quick comment on fundamentals. Regardless of what's going on with the midterms, I wouldn't be investing in 2026 if I didn't think there were sound fundamentals. That's where I always start, and I do think we have sound fundamentals. In spite of all the negativity and crying and complaining that we've heard over the last year, with all the geopolitical issues, with the tariffs, with the taco trades, with the AI bubble, name whatever you want to come up with, bottom line, the markets did extraordinarily well, again, especially if you had some diverse yet concentrated positions in the tech industrial side of things. And that trade is very profitable in terms of corporate earnings going into 2026. And we've actually gotten to a point where things aren't just all about a dozen or so companies. We've got a pretty much double-digit corporate profit expectations for much of the S&P 500 and even into some of the select mid and small cap companies. And these are companies that have been zombies for the last, 5 years. And it's just not the stock market. Again, put aside all the negativity, GDP growth is coming in higher than any of the, quote, experts thought it would. And that isn't likely to change much in 2026. So fundamentally, things are sound. But the big thing I want to focus on, and again, in a tongue-in-cheek, cynical manner in this episode, I'm going to talk about what I'm coining The Grifter's Guide to the Midterm Stock Market. And this is trading the Trump pump and the Democrat dump. Take that as humorous, take it as offensive, take it any way you like it. That's the way I'm positioning my portfolio for now anyways. So with sound fundamentals, I still want to own those industrial tech stocks, and I especially want to start owning the implementers of artificial intelligence. And we'll talk more about that in future episodes. But the pattern that I'm anticipating from the political side, from the midterm election side, is quite unique this time around. Oh yeah, any midterm election or any election year, the team that's in power, in this case the red team, they always do whatever they can to pump up and put liquidity into the economy and into the markets. So when the fools go to the election poll, they feel like they've got money in their wallet and they're happy. And likewise, during every midterm or full presidential cycle, the opposing team tries to point out all the flaws and create as much turbulence as they can to convince people how miserable they are and how bad the economy is. So again, when those fools go to the polls to vote, their wallets are empty. But we are in a very, very unique case, and oddly enough, a lot of that has to do with the out-of-phase cycle we're in because Trump is not having a normal 8-year presidential cycle. Right? He was in for 4, then he was out for 4, now he's back in for 4. I mentioned that in a previous episode about how that moved things kind of out of sync with appointing Federal Reserve, presidents and governors and such. And so it is playing out uniquely in the economy because of that. And then also, what's extremely unique this time around is that Trump came out with double barrels blazing, created massive global chaos, and instituted some very economic negative things like the tariffs. And I'll put economically negative in air quotes here because it depends on what results you're trying to achieve. But from an economic standpoint, from a traditional free trade standpoint, those were very negatively disruptive. But he put them on anyways. He let the market crash, or more appropriately, he didn't do anything while the market crashed back in April, but he let it ride. And at the same time, he came in and did some sweeping legislative and tax cut policies, which are very, very stimulative. And along with that, he came in with a great deal of deregulation legislation, making it easier for either companies to do business or ways for them to get around certain loopholes. That is incredibly stimulative, especially when you tack on those permanent tax cuts. And again, this is not whether you agree or disagree with what he did, it's just what it is. Those are going to kick in a big way in 2026. That's part of the pump. That's the major liquidity that's coming into the market. I'll mention some specifics there because I know people want to hear them, but they're actually very boring, wonky things, so I'm not going to get into any great detail there. But trust me on this, huge amounts of liquidity are coming into the market. And along with that, you would expect Trump, if he really wants to have success during the midterm elections, to lighten up on some of his chaos he creates because stock markets thrive on stability. So what I'm saying here is watch for the happy talk. Trump didn't do much or any of that in this first year, but it's very possible he will as a market calming method throughout 2026. And I bring up the happy talk first because the other part of the playbook, the blue team, the Democrats, they have almost no, and I mean almost no, liquidity levers to pull in 2026. And this is quite unusual, right? They not only don't control the executive branch, they don't control the Senate, they don't control the House, they don't even have a majority on the Supreme Court anymore. So really, all I think that they can do, and this isn't just like minor, I say all they can do, it's a huge offensive that they'll put on, but it's going to be talk. They're going to get all their fellow travelers, the governors of the blue states, the embedded bureaucrats in all levels of government, the labor union leaders, the academics, the corrupt fat cats all over Wall Street, the Hollywood types, Everyone, they'll parade all their mouthpieces in front of you nonstop to try and convince you how bad everything is. And in every attempt they have, they will try and sabotage the economy. But it's going to be more of a hit and run, drive-by, delay tactics than the bedrock policies that Trump has been able to put in place over these last 12 or so months. And if Trump does come out with happy talk, that will foil some of the negativity from the blue team. And unfortunately, I think for the blue team, a lot of their sandbagging and jawboning is ineffective. I mean, it used to carry a lot of weight, but there's a big majority, and this is not just in the U.S., but there's a big majority of people that just don't trust the institutions anymore. Choose whatever institution, whether governmental or not, and you'll probably find close to a majority of people that don't trust it. And again, this is not just a U.S. thing. We can point at examples of this all over the globe that's occurred in the last 15 years or so. But just as an easy one, it was no coincidence that in 2016, when Trump won this election in the U.S., something that most people, the pollsters, never thought he'd do. But what also happened that year? That was the year the pollsters also got wrong the Brexit. So again, whether you like it or agree or disagree or whatever, it doesn't matter. This is a phenomena that's going on, and you should try and figure out how to trade it to create the most profitable and stable positions in your portfolio. Okay, so aside from happy talk, and aside from the blue team sabotage, what's going to happen? It's all that liquidity that's pretty much guaranteed to come into the market and come into the economy in 2026. Let's look at the tariffs, or really more appropriately, the tariffs, as I mentioned in one episode last year. That's just one battle in the overall economic war we're in. We're talking about industrial trade policy, and this is a continuation of not only the tariffs and things that Trump did in 1.0, but it's also a continuation of what Biden kept in place and piled on during his 4 years. Remember the Inflation Reduction Act? Inflation Reduction Act had nothing to do with reducing inflation. It was an industrial policy for green technology. And Trump piled on even more with that last year, focusing on everything from pharmaceuticals to mining of critical metals and minerals, to either giving favorable practices to U.S.-based domestic manufacturers, or in cases where that wasn't possible, to incentivize or even force and twist the arms of foreign manufacturers to either increase their footprints in the United States or expand them. This is really an example of what happened to the Japanese automakers back in the 1980s. It's just on steroids, and it's beyond automobiles across virtually every area of manufacturing. These are beyond shovel-ready jobs, and if you look at the expansion that we've seen in industrial construction just since the pandemic, again, because this is not just a trend that happened last year, it's an ongoing trend going into its 6th year. It continues to build muscle and momentum, and there are manufacturing and industrial facilities being either built or refurbished in the United States like we haven't seen since the World War II buildup. Those are paying dividends in 2026. And a lot of that has to do with deregulation and getting arbitrary inhibitors to growth out of the way, whether it's EPA mandates or zoning laws or even bank regulation. You'll notice in my portfolio in the 4th quarter of last year, I went very heavy in the financial sector. I think especially the banks, both large and small, are going to benefit from 2 trends coming together. Number one, all this deregulation, really wiping away a lot of regulations that have been in place for the last 18 years. They're easing up on those on the banks, and that's at the same time that the banking sector is increasing its productivity because of artificial intelligence. Could be an extreme win-win for the banks, and I want to own them. And this is another part of that industrial policy. All that direct foreign investment that's coming in, it's got to be handled by our banks. And then a lot of this is all just summed up around the one big beautiful bill. Again, whether you agree or disagree with it, or even if you know about it, the bottom line is It's a major stimulative impact on the economy. It's been in place for about the last 8 months or so, and so with the variable lags of the economy, we should see a lot of that liquidity hitting into the stock market and the general economy in 2026. We're talking about immediate and 100% expensing and depreciation of CapEx equipment for corporations and small businesses, and that's everything from buying an SUV as a company car, to factories, to technology, computer systems, 3D printers, office furniture, whatever legitimate business equipment type expense that a business needs. And on top of that, there's the R&D incentives. In fact, even if you own a small business, you should look into how you may be able to write off research and development for your company. It's not as hard as you may think. And what that would involve is having someone on staff that dedicates all or a portion of their hours to researching and developing new products and procedures for your business. There's a lot of money that can go down that black hole. I mean, think about how you could apply that if you're running a Somali daycare or education center in Minnesota. In any case, I haven't even talked about the overall permanent tax cuts that are put in place from Trump's first term, and then the carve-outs and incentives that go to specific industries, and especially a lot of that has gone to oil and gas. And Trump did that because he had that drill baby drill mantra, which really wasn't good for U.S. corporations, at least initially, until they carved out more of the leases and the oil and gas tax incentives. But that does take us into oil, and this is about the biggest point I can make in all this. Everybody has complained about how prices are going up because of tariffs, but consider how far the average man's paycheck goes because of lower oil prices. That whole drill baby drill, again, that wasn't as much about domestic production as it was about getting the Saudi Arabians to overproduce. Think back to May of 2025. It was the first official state visit for Trump as he left the country. Where did he go? Who did he visit? Which major ally was it? Saudi Arabia. And while he was there, he visited Qatar, the United Arab Emirates. And then think about how Saudi Arabia played a key role in some of the Ukrainian negotiations. Oh, and the bombing of Iran? How much of that was for our buddies in Israel or for Iran's other arch-enemy, Saudi Arabia? Listen, this drill baby drill, whether it's on domestic lands or not, has had a major impact on the price of oil. And just this weekend, I don't have to remind anybody, we went in and did an abduction of Maduro in Venezuela, which controls the largest oil reserves in the world, specifically very heavyweight oil that our refineries love to run on. And while that's not going to be pumping overnight, it's a card that the U.S. can play in terms of not specifically domestic oil production, but in hemispheric oil production. And as we get into 2026 and we start doing deals with Canada and Mexico, which is where the U.S. gets a lot of its heavyweight oil reserves, well, now this is another card or another chip that the U.S. can play in negotiations by bringing very inexpensive and abundant Venezuelan oil into the mix. What all this means is look at the price of gas right now. Post-pandemic, gasoline prices at the pump have collapsed. From the highs, they're down some 40%. And on just a weighted general average, you're looking at a good 20% discount over where oil prices have been in the last 5 years. People feel that in their pocketbooks. You can see that at the pump. You can see that at the price of oil. Today, oil's trading around $57 a barrel. That's easily 20-25% or more down from the weighted average of where it has been over the last 5 years during this post-pandemic period. So one area you're definitely seeing deflation is in the price of oil and gasoline, and that's where consumers feel it most on a daily basis. That's the liquidity that I'm talking about that's part of that Trump pump. And though, again, it'll be foiled by a lot of Democrat dumps, I think the strategy that you want to take in 2026, or certainly the one that I'm taking, is to stay fully invested in my portfolio that's focused on industrial technology and especially those companies like the banking sector that are implementing artificial intelligence and benefiting from deregulation, and then putting your blinders on, ignoring all the noise and static and negativity and sabotaging. And when those black swan events or flash crashes occur, have some spare cash on hand to buy the dip. And I think this strategy will likely work at least through November. After that, it could be a whole new ballgame, but we'll worry about that in future episodes. Hey, as always, until next time, this is John Pugliano wishing you the very best returns.